All right, welcome back to the channel. Today we're going to be taking another glance at Enphase because it is getting absolutely destroyed. They recently reported Q3 earnings, and yeah, it wasn't very pretty. So they actually barely missed, I think, on their revenue. They beat or met/beat their EPS, but their guidance was absolutely horrific. And if you go back to Q2, the narrative for managing Q2 is like, hey guys, we got inventory buildup, and we're just gonna hit it really hard and reduce our production from Q2 to Q3 and try to get that inventory built up, like, diminished a ton. And then Q3 comes around and they're like, hey guys, yeah, it was worse than we expected. So they kind of met their Q3 numbers, but they weren't able to churn through enough inventory that was already out there. And because of that, their guidance for Q4 and it sounded like Q1 was going to be pretty horrific as well. So if we jump into their investor presentation, we can see some details here and there. Gross margins actually went up on a year-over-year basis, and I believe a Q-over-Q basis too, which was pretty interesting to see their gross margins go up with their revenue declining so much from, I think it was like 780 million in the previous quarter to about 551 this quarter. So their margins are actually maintaining, and I'm assuming that's just because they use a lot of fabs to build these, and they have agreements with the fabs, so their costs are relatively, like, I don't know, stable when it comes to the production. So it's interesting that their revenue declined so much, yet their gross margins stayed relatively healthy, and along with their net margins as well. So all right, so let's go through here. We can see we got GAAP net income of 114 million, free cash flow of 122 million. Yeah, I mean, pretty decent. I mean, we kind of expected that there was going to be a pullback in demand. And now that this is playing out, you know what it kind of reminds me of? It kind of reminds me of when the chip market for PCs took an absolute dive, like absolute tank, right? Basically, everybody was buying PCs going into COVID. We had a front load of demand, and then when that normalized, they saw like a 50% pullback. So it kind of reminds me of that. This is just offset a little bit further into the cheap money cycle, and now we're starting to see that massive pullback with interest rates going up, kind of discretionary spending dropping. But it will be interesting to see long term exactly how that kind of normalizes between solar products getting cheaper to manufacture versus utility rates kind of steadily increasing at their inflation-based rates that they usually do. So basic EPS was 84 cents compared to $1.15, so still 84 cents on EPS, not too bad. Revenue, now this is where it gets really interesting. I'm gonna breeze through this and go to the financial outlook. Fourth quarter 2023 financial outlook. Revenue to be within the range of 300 million to 350 million. Absolutely just destroyed on a year-over-year basis. If we go to their revenue in Q4 of 2022, what was that at? That was around 724 million. So they're looking at over a 50% decline in revenue in their top line in 1 year. So, oh my God. Talk about cyclicality. Now, management did kind of give the narrative that they're expecting to churn through about 150 million in inventory. So the thing that I'm really interested in, and I haven't been able to find this data yet, is I really want to see their end demand rather than their revenue, right? Because their revenue is just the sales to the distributors, and then the distributors basically distribute out to the customers, right? So what I would kind of like to see is the end demand on a quarterly basis from the customers versus the distributor demand. Because what we might have happening is that as we were going through in 2020, 2021, 2022, and demand was increasing more and more and more and more as we had those tailwinds for solar, we could have had distributors over ordering, which obviously now it's like, yeah, they're over ordering. But I really want to know kind of what the curve of customer demand versus distributor demand was. Because if customer demand, if they do get through 100 to 150 million in inventory during that quarter, that means that their customer demand was still about 450 to 500 million. So to me, what is really interesting, and I wish I could find the data, maybe I can somewhere. If you guys know where to find this data, like, tell me in the comments, because I'm very interested in this. I really want to see the end customer demand. If I can see the end customer demand and I see that, yeah, distributors were definitely over ordering and end customer demand was kind of like steadily rising, but it's not like as drastic of a pullback as the distributor demand, then, you know, that gets pretty interesting, because eventually that inventory is going to burn off. Well, they're going to sell through that inventory, and then they should normalize back to that customer demand level where they have their kind of sell-through rate, and their inventory is going to be more aligned with what they're pushing out to distributors. So absolute destruction on the stock price. It was kind of fun to see. But I think they're down to about 78, 80 bucks right now. If we go over to the overview tab, yeah, we're down to about $78. Yeah, that's pretty rough. Check out link to the Discord below, you know, yeah. And we've got this template on there for supporters, and you can become a supporter by posting 3 write-ups, or there is also a tier you can subscribe to. So yeah, it's going to be pretty dang interesting. We're sitting at about $78 right now, and I did a video on this one previously, and even in that video my assumptions were pretty like bullish, I would say. I wasn't taking extreme like negative scenarios. And we're going to rerun that here in a little bit and see kind of what we come up with now. And I'm going to be a little bit more bearish on the scenarios, but not like super bearish. I'm just going to take into account more of the cyclicality and this cycle potentially being lower and longer than we expected. So the narrative for management is that the inventory churn is probably going to last through Q1 of 2024, and they're hoping things pick up in Q2 2024. But you know what, we'll see. We'll see what happens. I've been looking at solar personally for our property just because the rebates are so dang good, and the cost of just the equipment, and I'm cheap, so I don't look at Enphase equipment or Tesla equipment, but the cost of just the equipment has come down pretty significantly. I was actually pretty surprised. I feel like I've been keeping an eye on it throughout the years. I feel like it's halved. So cost-wise, it seems like it's getting more and more competitive, and as the costs and efficiencies just increase and costs go lower, it should be more and more competitive with traditional utility rates. So this is very interesting, but let's go ahead and get into the valuation. The other thing that I want to note real quick before we jump into the valuation is they have been repurchasing stock. They bought 846,000 shares in Q3 for about 110 million, and that means average cost of 129 per share. So hey, my cost basis is better than them. My very, very, very small starter allocation. So that means that they have probably about 890 million left in their 1 billion buyback plan. So and it presents an interesting situation, because if they do sell off into suppressed like super suppressed levels, kind of like they are now, but I think it could get like even worse potentially, depending on the next couple quarters. But if they do sell off into those suppressed areas, but they remain, you know, cash flow positive, maybe their revenue goes down drastically, but they keep their gross margins, their net margins are decent as well. They maintain that cash flow, and they're able to repurchase some shares during that cyclical downturn, and then they revert to mean when the cycle kind of reverses, or they get through the inventory and things normalize a little bit. It could potentially turn into a really, really good time to buy back shares. However, I would not want them to really buy back those shares if it meant really destroying their balance sheet, right? They're going to have more, I don't know, accurate information or guesses as to how bad this cycle is going to be, and the health company, well, hopefully the health company, but I would rather them kind of maintain a neutral cash and short-term investment state, kind of keep this 1.5 billion or so, and slowly buy back stock with their free cash flow, rather than depleting a lot of their cash just to buy back stock, and then they potentially get into a bad situation where maybe they go free cash flow negative because the cycle is worse than they assumed, and they get into a position where maybe they have to raise expensive debt or dilute, which would be the exact opposite of what you would want to do when you go through a buyback phase. So let's go ahead and jump into the evaluation. So I use Financial Modeling Prep for all of the API queries for my spreadsheets, and I do have a referral to Financial Modeling Prep in the description below. It takes about 20% off of the normal pricing. Additionally, if you want access to this valuation template, you can join the Stone Cold Investors Discord, and that link will be in the description below, and the valuation template is available to all supporters of the Discord. You can become a supporter of the Discord by writing 3 different valuation or company write-ups in the Stone Cold Investors Discord, or if you don't want to do any of that and you just want to lurk around, you can sign up for a $5 a month supporter tier, which will give you access to the channel that has the valuation template. All right, let's start off with this. So it's right here, I've got about a target rate of 20%, margin safety is 2.5%, base credit guard is 17.5%, so we are shooting for a higher target rate, just because the risk on this one is going to be pretty crazy, pretty volatile. Dilution, this is the biggest change from the last 5 years, is that they're probably in a buyback state now. So maybe we see 1% in buybacks or something like that. I'm not really, I kind of expect this to be kind of flat. I think they bought back enough shares to reduce their float by about 0.5% last quarter. So if we go to actually income statement, where do we got? So weighted shares, diluted outstanding, 145 to 143.8. So yeah, they're going to be back if they keep buying back. They might be able to buy back at a rate that's higher than what they're issuing in SBC, and make a dent in their shares outstanding total. So we could probably increase that a little bit if we really want to. Maybe do like 15, whoops, not 15, negative 15, and then we have a buyback rate between about 3.27, and in that case I'm going to increase the spread, and we're going to do like a negative 30 or negative 25 maybe, and we go from, let's do negative 30, and we got buybacks in the amount of 3.27% down to 0.79%. Now, bottom line growth on the historical 5-year period has been about 65.82%, which obviously that's probably not going to happen. On a normalized basis, it might. And, other good point. I am normalizing this, so I'm taking the average out of the last 3 years. So bottom line growth, we got from scenario 1 to scenario 5, we got 23.92% to 45.82%, and this is going off of the normalized numbers, so it's accounting for a decent pullback already. Average yield spread, we got 2.89 to 5.97, and if we go down here, we can see that we are basically at pretty much highs for what the security has been yielding to the bottom line. But that's kind of like, we could be getting into one of these situations where it's expensive when it looks cheap, and it's cheap when it looks expensive. And what that really goes to show is that usually at the bottom of the cycle, where everything is the worst, you're gonna have drastically suppressed earnings. You're going to look expensive, but you've already hit the bottom of the cycle. You're most likely on the upswing. So future income could be a lot better than expected if that cycle does revert. So with that being said, oh man, and I'll show you the revenue breakdown. What I'm kind of going for is I wanted in year 3 or year 4 to basically recover our bottom line metrics to the previous highs. So previous highs were about, let's see, 669 million for EBIT, 572 million for net income, and about 844 million for free cash flow. So we can see in the base case, that basically gets recovered. Free cash flow recovers a little bit quicker. I could probably have done this just with like EBIT to kind of make it smooth out a bit, but we basically have a recovery to the previous highs. So let's see, after about 3.5 years or so. So that's kind of what I'm shooting for. You could, if you wanted to, you could say, okay, I don't want to recover until like 5 years, and then that would change things pretty drastically. So if we did that, yeah, our points would be a lot higher, or a lot lower for the buy points. So right now, we're assuming that they will have some type of recovery to previous highs and a resumed trend over the next 3.5, 4 years. And so that's probably going to look like pretty much a normalization of this growth. So we've kind of ebbed and flowed over the last 10 years, ran up really, really high. I'm expecting this pullback to get obviously even deeper because we have about 551 right here. So we're going to pull back to, oh man, I mean, they could potentially hit points if they have too much inventory to churn through and we see just a total demand drop off. Yeah, maybe they only do 250 in revenue in Q4 or Q1. It is possible. So this could revert to potentially pre-COVID levels, 210, 250, who knows. But even if it reverts to 210, 250 and you're at the bottom of the cycle and you're still profitable and they're buying back shares, might not be that bad. So I'm expecting a quick reversion here and then normalization and then eventually a decent recovery. Assuming they can keep their competitive advantage in the marketplace, which I do think Tesla threatens that. What's the other end? Solar Edge, I think. I'm not worried about them at all. Just looking at the differences in the technology and what I've researched, I don't think Solar Edge really holds a threat to Enphase at all. So getting back over to the evaluation template, we can see yield multiples at the end of the 5-year period are about 6% to 2.89%, target KGAR 20%, and that spits out a scenario 1 buy price of $38, scenario 2 buy price of $55, scenario 3 buy price of $83, so we would be in the scenario 3 buy price range, scenario 4 buy price of $127, scenario 5 buy price of $203, and obviously, if it hits these upper scenarios, then it's gonna be pretty good to long term. But also, I would say you could even be more bearish in this. If we wanted to say that they are not going to recover their previous highs in net income and bottom line until year 5, well, then we would have to change this to neg 35, I think. Let's see. So the base case, trying to get to, yeah, that's pretty close. It's pretty close. So that would be pretty close to a recovery in year 5 to previous net income and bottom line income highs. And in that scenario, which honestly might be a better scenario to go off of. You've got a scenario 1 buy price of 27, a scenario 2 buy price of 38, a scenario 3 buy price of 54, scenario 4 78, scenario 5 118. 5-year target prices off of this more conservative scenario would be, scenario 1 would be 72, scenario 2 would be 100, scenario 3 would be 141, scenario 4 would be 205, and scenario 5 would be 308. If we jump back to the other one and go neg 20, Then our 5-year targets are about $100, 145, 217, 333, 531. So, yeah, it's gonna be interesting. I'm gonna probably be holding tight. I might nibble a little bit here and there. I'm not in a huge rush because I think this one's gonna give plenty of time to accumulate. We've got probably a couple pretty rough quarters in front of us, and then from there, who knows what happens. So, but I'm very interested in the industry. I'm very interested in the technology. So yeah, this is going to be a very fun one to watch. What do you guys think? Let me know in the comments below. If you know a way to get that data I was talking about the end consumer purchases versus the distributor purchases, please let me know, because that'd be very, very interesting. And I think it could shed a lot more light on how much of the cycle is due to inventory buildup versus crushing demand. So have a good day, and we'll catch you in the next one. As always, I am not a financial advisor, and none of this is financial advice. This is just my musings on another company and another potential valuation. So I hope you enjoyed it. If you did, please hit the like and subscribe button, and we'll see you in the next one.